Have you ever wondered how the super rich, those with more money than they could ever spend, handle their taxes? It's a question that sparks curiosity and sometimes a little outrage. We regular folks grumble about tax season, but what about billionaires? Do the same rules apply? The answer is more complicated than a simple yes or no. Welcome to the fascinating world of billionaire taxes, where fortunes are built and taxes are strategically navigated. We're about to dive deep into the legal loopholes, clever strategies, and ethical debates surrounding how the ultra-wealthy manage their taxes. Get ready for a wild ride through the world of high finance, where every dollar saved is a testament to meticulous planning and a system seemingly designed to benefit the few. Buckle up, because things are about to get interesting. In the United States, our tax system is built on the idea that everyone contributes their fair share. The more you earn, the more you pay, right? Well, that's the idea at least. For us regular folks, most of our income comes from our salaries. We pay taxes on those earnings, and that money funds essential services like roads, schools, and healthcare. But for billionaires, it's a different ballgame. Their wealth isn't primarily tied to a paycheck like ours. Instead, it's often tied up in investments, stocks, and assets that generate enormous profits. And here's the kicker. The way those profits are taxed is very different from how our hard-earned salaries are taxed. This is where the plot thickens and the lines start to blur. Enter Warren Buffett, the Oracle of Omaha, a legendary investor and one of the wealthiest individuals on the planet. Buffett is known for his folksy wisdom, his long-term investment strategy, and surprisingly, his outspoken views on taxes. Here's a man who openly admits to paying a lower tax rate than his secretary. How is that possible? Well, Buffett's tax strategies, while perfectly legal, have drawn both scrutiny and admiration. He's a master at exploiting the nuances of the tax code, utilizing charitable deductions, and leveraging his investment holdings to minimize his tax burden. And he's not alone. Countless other billionaires employ similar tactics, sparking a heated debate about fairness, ethics, and whether the system needs a major overhaul. Alright, let's break down this whole tax thing. In the US, we have what's called a progressive tax system. Sounds fancy, right? Basically, it means the more dough you rake in, the higher your tax rate. Think of it like a ladder with different income brackets representing each rung. The higher you climb, the more you shell out in taxes. For us everyday folks, our income is taxed through payroll deductions. We get our paychecks and boom, a chunk of it's already gone to Uncle Sam. It's not exactly a party trick, but hey, that's how we fund our country. This money goes towards essential services like roads, schools, and healthcare. You know, the stuff that keeps our society running. But here's where things get interesting. The tax code isn't a one-size-fits-all situation. Section 2 of Paychecks and Portfolios: How Billionaires Make Their Money. Billionaires don't make their money from a 9-to-5 gig. Their wealth isn't tied to a regular paycheck. It's all about assets. Think stocks, real estate, you name it. These investments generate massive profits and are taxed differently. Gains are often taxed as capital gains. It depends on how long they hold on to those assets. Short-term gains are taxed at regular income tax rates. Long-term gains are taxed at a lower rate. It's a financial loophole for the wealthy. Section 3, Capital Gains, the billionaire's best friend. This, my friends, is where the plot thickens. Remember that progressive tax system we talked about? Well, capital gains taxes don't quite play by those rules. They have their own, more favorable rates, which just so happen to benefit those who earn the most from investments. It's like a VIP line at the tax office, reserved exclusively for the ultra-wealthy. Now, you might be thinking, hey, isn't that a bit unfair? And you wouldn't be alone. Critics argue that this preferential treatment for capital gains exacerbates income inequality. They say it allows the super rich to pay a lower effective tax rate than those who earn a fraction of their income through wages. And let's be real, when was the last time you heard of a billionaire struggling to make ends meet? This discrepancy in how income is taxed is at the heart of the debate over wealth, inequality, and tax fairness. Section 4. The charitable loophole. Giving back or getting ahead. Charitable giving is a good thing, helping those in need and supporting causes, but it can also reduce tax liability for the wealthy. They can deduct donations from taxable income. Critics argue this benefits the wealthy disproportionately. It's a complex issue, highlighting the relationship between philanthropy, taxes, and wealth. Alright, let's get back to Warren Buffett, the king of low taxes. He's famously said he pays a lower tax rate than his secretary, and he's not wrong. But how does he do it? Well, it's not magic, it's smart planning and exploiting perfectly legal loopholes in the tax code. See, Buffett understands that it's not just about how much money you make, but how you make it. He primarily earns income through long-term investments, which are taxed at lower capital gains rates than ordinary income. Remember that VIP line at the tax office? Yeah, he's basically a platinum member. But wait, there's more. Buffett also strategically uses charitable donations to offset his tax liability. He's a big philanthropist, donating billions to charitable causes, but those donations also come with hefty tax deductions. It's a classic case of doing well while doing good, all while minimizing his tax burden. Now here's where things get really interesting. Billionaires, despite their unimaginable wealth, often report surprisingly low taxable incomes. How is that possible, you ask? Well, they've mastered the art of living below their means, at least according to the IRS. You see, many billionaires don't take huge salaries like you might expect. Instead, they take out loans against their assets, like stocks and real estate, to fund their lifestyles. The beauty of this strategy is that loans aren't considered taxable income. So, they get to enjoy their lavish lifestyle without the tax burden that comes with a massive paycheck. It's like having your cake and eating it too, all while keeping Uncle Sam out of your dessert tray. But wait, there's even more. Billionaires are also masters at using complex business structures to minimize their tax liability. Think of it like a game of financial chess, where every move is strategically planned to protect their wealth. One common tactic is to set up trusts, which are legal entities that hold assets for beneficiaries. Trusts can be structured in a way that shields income from high taxes, especially estate taxes, which we'll get to later. They also often use limited liability companies, or LLCs, to manage their investments and businesses. LLCs offer liability protection and can be structured to take advantage of favorable tax laws. It's a complex web of legal and financial maneuvers, all designed to keep more money in their pockets and out of the government's coffers. Section 4. Dynastic wealth and the estate tax, passing fortunes to heirs tax-free. Now let's talk about death and taxes, two things we can't avoid, right? Well, not so fast. While us regular folks might have to worry about our heirs paying estate taxes on whatever we leave behind, billionaires have found ways to keep those fortunes in the family tax-free. They do this through a clever combination of trusts, gifts, and charitable donations. By strategically transferring wealth during their lifetimes, they can minimize the amount of their estate that's subject to taxes. It's like a financial game of hot potato, passing the wealth down through generations while dodging the taxman at every turn. This strategy ensures that their wealth remains within their family dynasty, potentially for generations to come, without being significantly impacted by estate taxes. Section 5. The ethics of avoidance. Is it wrong to pay less than your fair share? Is it ethical for billionaires to avoid paying their fair share of taxes? While they use their wealth to minimize taxes, others struggle to make ends meet. This sparks heated debates. Some argue it's legal and the government's job to close loopholes. Critics say it worsens inequality and deprives essential services. The wealthy, they argue, should contribute more. The debate highlights the tension between the ultra-wealthy and society. Section 1. The wonderful world of deductions, writing off the high life. Now let's talk about deductions, the magic words that can make a billionaire's tax bill disappear faster than a private jet to the Bahamas. You see, the tax code is riddled with deductions, which are essentially expenses you can subtract from your income before calculating your tax liability. For us regular folks, deductions might be things like mortgage interest or student loan interest. But for billionaires, it's a whole different ballgame. We're talking about deducting the costs of private jets, yachts, luxury homes, you name it. They can even write off things like art collections and expensive wines as business expenses. It's enough to make you wonder if the IRS has ever actually audited a billionaire. These deductions are often justified as necessary business expenses, but it's hard not to see them as a way for the ultra-wealthy to maintain their lavish lifestyles while minimizing their tax burden. Section 2, Depreciation, the billion-dollar tax shelter. Hold on to your hats, folks, because this next loophole is a real head-scratcher. It's called depreciation, and it's a tax break that allows businesses to deduct the declining value of assets over time. Sounds reasonable, right? Well, here's where it gets interesting. Billionaires often own assets that appreciate in value, like real estate or artwork. But through clever accounting maneuvers, they can still claim depreciation deductions on these assets, even though they're actually gaining value. It's like claiming your brand new Ferrari is rusting away in the garage, even though you're driving it around town like a boss. This loophole allows them to offset their taxable income and reduce their tax liability, all while their assets continue to appreciate in value. Section 3, Carried Interest, the private equity loophole. Now let's dive into the world of private equity, a notoriously opaque industry where fortunes are made and taxes are often minimized. At the heart of this tax-saving scheme is something called carried interest. Here's how it works. Private equity managers typically receive a percentage of the profits from their investments, known as carried interest. This carried interest is taxed at the lower capital gains rate rather than the higher ordinary income tax rate, even though it's essentially compensation for their work. It's a loophole that has been criticized for years, as it allows these ultra-wealthy fund managers to pay a lower tax rate than their secretaries, teachers, and firefighters. Despite calls for reform, carried interest remains a powerful tool for private equity titans to minimize their tax bills and maintain their privileged status. Section 4. Offshore accounts. Hiding money in paradise? Alright folks, time for a trip to paradise, or at least that's what the brochures for these offshore tax havens promise. You see, some billionaires take their tax avoidance game to the next level by stashing their wealth in offshore accounts. We're talking about countries with low or even zero tax rates, often with strict secrecy laws that make it difficult for authorities to track down these hidden assets. Now, it's important to note that not all offshore accounts are illegal. Some are used for legitimate purposes, like facilitating international business transactions. But there's no denying that offshore accounts can also be a haven for tax evasion and money laundering. It's a shadowy world of shell corporations and numbered accounts where the super rich can shield their wealth from the prying eyes of tax collectors. So we've explored the intricate and often infuriating ways billionaires navigate the tax system. But the question remains, is it fair? Is it right that they can exploit these loopholes and pay a lower effective tax rate than many middle-class Americans? This is the heart of the debate over wealth inequality and tax justice. Proponents of the current system argue that it encourages investment and economic growth. They say that closing these loopholes would stifle innovation and harm the economy. But critics argue that it's simply unfair for the ultra-wealthy to pay a lower tax rate than those who are struggling to make ends meet. They believe that closing these loopholes and implementing a more progressive tax system would generate much-needed revenue for essential services and reduce income inequality. It's a debate that is sure to continue for years to come, as the gap between the haves and the have-nots continues to widen. Remember when those Pandora Papers dropped? Suddenly, the secret world of offshore accounts and tax havens was splashed all over the news. Politicians, celebrities, and yes, even billionaires were caught with their hands in the cookie jar, hiding wealth and dodging taxes. The public outrage was palpable. People were furious, and rightfully so. Here we are, struggling to pay our bills, while the ultra-wealthy are playing by a different set of rules. It felt like a slap in the face, a stark reminder that the system is rigged in favor of the few at the expense of the many. The Pandora Papers and other high-profile leaks like it have fueled a growing movement demanding tax fairness and accountability. People are fed up with the double standard and they're demanding change. Let's be real, nobody likes paying taxes. It's like pulling teeth, except instead of a tooth, it's your hard-earned money. But here's the thing. Taxes are the price we pay for a functioning society. They fund our schools, roads, healthcare, and everything else that makes our country tick. So, when billionaires use their wealth and influence to avoid paying their fair share, it undermines the very fabric of our society. It's like skipping out on the bill at a restaurant while everyone else is stuck covering your tab. It's not just about the money, though. It's about the message it sends. It says that some are more deserving than others, that the rules don't apply equally. And that, my friends, is a recipe for resentment, division, and social unrest. Alright, enough with the doom and gloom. Let's talk solutions. How do we fix this broken system and ensure that everyone pays their fair share? Well, experts have been proposing reforms for years, but they often face stiff opposition from, you guessed it, the wealthy and powerful. One popular idea is to close the carried interest loophole, which allows private equity managers to pay a lower tax rate on their earnings. Another is to implement a wealth tax, which would tax a small percentage of a person's net worth above a certain threshold. And of course, there's always the option of raising taxes on the highest earners and corporations, which hasn't happened in any meaningful way for decades. These reforms won't be easy to implement, but they're essential if we want to create a more just and equitable society. The debate over billionaire taxes isn't just about numbers on a spreadsheet, it's about fundamental questions of fairness, justice, and the kind of society we want to live in. It's about ensuring that everyone has an equal opportunity to succeed, regardless of their background or zip code. It's about creating a system where the wealthy contribute their fair share to support the common good, rather than hoarding their wealth in offshore accounts and dodging taxes like it's an Olympic sport. It's about building a future where everyone has access to quality education, healthcare, and opportunities to thrive. The road to tax fairness won't be easy, but it's a journey worth taking. Because a system that only benefits the few at the expense of the many is not a sustainable or just system. It's time for a change, and it starts with demanding a fairer, more equitable tax system for all. Look, this whole billionaire tax situation is a trip, right? We've gone deep into the loopholes, the deductions, the offshore accounts. It's enough to make your head spin. But here's the thing, it's not just about the money, it's about the kind of society we want to live in. Do we want a world where the ultra-wealthy operate by a different set of rules, dodging taxes while the rest of us struggle? Or do we want a world where everyone contributes their fair share to support the common good? So what do we do about it? Well, we demand better. We demand a fairer, more equitable tax system that ensures everyone pays their fair share. We call on our elected officials to close the loopholes, crack down on tax havens, and implement reforms that level the playing field. We support organizations and movements fighting for tax justice and economic equality. We educate ourselves and others about the issue and engage in constructive dialogue about solutions. This isn't a partisan issue, it's a human issue. It's about creating a world where everyone has an equal opportunity to succeed, regardless of their background or zip code. It's about building a future where everyone contributes, everyone benefits, and everyone has a shot at the American dream. Because a system that only works for a select few is a system that's ultimately doomed to fail. Let's rewrite the rules and create a future worthy of our aspirations. If you enjoyed this video, please like, share, subscribe, and leave a comment below.